Welcome all to Corporate Issuers Learning Module 5, Capital Investments and Capital Allocation. Before we get into the LOSs, let's revisit a simplistic balance sheet that veterans of Learning Module 4 will recognize. Back in Learning Module 4, when we were focusing on working capital, we grouped our current assets and current liabilities together to give us working capital, all of our invested capital together, and said, some of that invested capital is tied up in working capital, but the rest, which is what we're excited about in this module, goes into long-lived assets, capital investment, long-term investment, which hopefully will generate returns big enough to meet the required returns of our providers of capital. Whether it does or not depends on the capital investment and allocation process that management goes through. They are key to the success of this company, of this firm. And analyzing those investment decisions and that process gives analysts insight into the quality of management decisions and how the company is creating value, if indeed they are. So that's where we're at, the long-term focus in this learning module. And the first LOS will simply ask us to describe types of capital investments. What are the kinds of long-term projects we might invest in? There are 4 of them, but before we define them, we'll talk a little bit about depreciation because it's a key concept when looking at NPVs of projects. You'll meet it when you get to FSA. It's an accounting concept. You'll do a lot of it there, but they give us a little overview here just so we're aware of it. So, definition of capital investments. Investments of 1 year or longer. Really, that means 1 accounting period or longer, which means we're going to create long-term assets on the balance sheet. When we buy assets, long-term assets, they go onto the balance sheet as an asset at cost. They don't go to the income statement as an expense immediately. Why? It's the matching concept. If you go out and spend $400 million on a machine that's going to earn you revenue for the next 8 years, it makes no sense to show a $400 million cost this year and revenues for the next 7. So instead you match the cost to the revenues. How? By charging depreciation if it's a tangible asset, amortization if it's intangible, periodically to the income statement, smoothing that capital spending, matching it to the benefits earned. On the balance sheet, you will reduce the value of the asset by the depreciation or amortization you've charged. In the cash flow statement, well, you can't argue that you've spent the cash. You can do all the smoothing you like in the income statement, and we will, but the cash flow statement tells you the truth about cash, so you will see the $400 million outflow in cash flow from investing. CFI, something you'll become intimately familiar with once you've been through financial statement analysis. Here's a little example just to make sure we're on top of it. We've got PPE here that cost $120,000. Estimated useful life is 3 years. Really simple calculation here. A cost of $120 over 3 years. We are charging depreciation of $40,000 a year. Those of you who are familiar with depreciation will recognize that this is straight line depreciation, and we are assuming there is no salvage value. Yes, it could get more complicated. We'll save that for FSA. But in this simple example, what does it mean? It will go onto the balance sheet initially at $120,000. In year 1, we will charge the first depreciation expense of $40,000. So year 1 profit is reduced by $40,000. And at the end of year 1, PPE on the balance sheet will be at $80,000. The $120,000 cost less the $40,000 depreciation. In year 2, we'll charge $40,000 depreciation again to the income statement. Again, in year 2, profit is reduced by $40,000. By the end of year 2 on the balance sheet, our net PPE will now be $120 cost less the $80 cumulative depreciation, the 2 years of $40. Year 3, $40,000 depreciation expense again. That $40,000 is written down to 0. It's the end of the asset's life, and it is removed from the balance sheet. So a quick intro before we got into the types of projects, just to make sure you're aware of depreciation and how it flows through the financial statements. But that's out of the way. So let's get in to the projects. The first one, an absolute thriller, a regulatory compliance project. Not discretionary. We're doing this quite simply to meet rules and standards, be they health and safety, environmental pollution, who knows. Typically, they will simply be an expense without any revenue attached. But that obviously doesn't mean you don't do them. You do them to avoid fines and to allow the business to continue. Otherwise, if you just don't meet the rules, they'll fine you, and eventually shut you down. Another little bit of good news, it may provide a barrier to entry, protect your profitability. Might make it difficult for people to join the industry if they have to spend a huge amount getting up to code, if you will. And if you can, you could work with regulators to tailor the timing and the impact of the regulations to suit your business. Get somebody on the inside. Maybe one of your former board members or CEOs is now a regulator. That helps. And if you are an early adopter, if you bring this in before you needed to, it might give you a competitive advantage. Particularly thinking around the world of ESG these days, which seems to be a hot topic. If you can get ahead of the game and be greener than everybody else, then maybe that will attract customers. But obviously, it's going to be expensive. High regulatory costs may reduce returns below your minimum required level. If you're on razor thin margins already, and all of a sudden you have to make all of your plant and equipment a lot greener, might not have the margins to sustain it. Two choices really, stark choices. Pass it on to customers if you can, but if you don't have the power in that relationship, you may well have to cease operations. So there's your first project, compliance. Next up, going concern, which involves maintenance capital expenditures. Now, be a little bit careful around this term if you have already studied FSA or you are a financial statements veteran already. Maintenance capital expenditures might sound a little bit contradictory to you. The term here means it's capital expenditures, so we are definitely spending on PPE, property, plant, equipment, or intangibles, but it is simply to maintain your current operations. That's what it means by maintenance. FSA veterans may have panicked and said, well, hang on, if it's maintenance, it's repairs, that's an expense, it's not CapEx. Not what it means. It means spending to replace existing assets to keep your current operations going, as opposed to growth, which we'll look at separately. So it's there to maintain your existing business size. As your plant runs out, you need to replace it. So it could simply be replacing an asset that's run out. It might be that you need new hardware and software to keep your systems running, because obviously they become obsolete pretty quickly. It might be improving your existing facilities to make them better to work in as a workspace, as plant and equipment, who knows. But it's not growth, that's the key. The risk of these kinds of projects, low. They are easy to evaluate. We know what the machine cost last time. We should be able to work out what it's going to cost this time. You know the upfront cost, and let's say it is to improve existing facilities. You're going to make your production process more efficient. You should be able to calculate the savings you'll make from those efficiencies. Compare the two. It's a fairly easy project to appraise. Funding. Exciting thing here is matching it, getting the term right. Match the term of your new finance, if indeed you're raising new finance, to the lifespan of the new assets. Why? Avoids rollover risk. Rollover risk is when your debt matures and you have to roll it over into new debt, leading to uncertain financing costs and an uncertain availability of debt. Who knows if it will even be available? There may be another crisis on the way. So keep it at least as long as the lifespan of the new assets, and preferably exactly as long as the lifespan of the new assets. If it matures after the end of the project, longer debt may cost you more if it's an upward sloping term structure of interest rates. it's going to cost you more. And if you have debt lying around that you no longer need, it might cost you more. It might involve a premium to buy it back. So try and match the term. Now, as analysts, what are we looking at? You look at a company trying to decide what it's spent in total CapEx. You're interested in how much they're spending just to keep the business going, but also how much they're spending to expand. The downside, you don't get that level of detail. You don't get that kind of disclosure in the financial statements. So we're going to have to guess. A posh word for guess is obviously estimate. So we're going to estimate the level of annual maintenance CapEx using depreciation and amortization. Makes sense. Depreciation is meant to measure over the life of the asset how much use you've had out of it, how its value is dropping. And it's accounting terms because it's straight line, so it's really just an estimate, but it's spreading that cost over its life. When it hits zero, it will need replacing. So we'll estimate maintenance capital expenditures as the level of depreciation and amortization, which we will be able to dig out from the footnotes to the financial statements. It will be disclosed in there. Is it accurate? Well, depends on whether the useful life of the asset was accurately estimated. We had an asset which was 3 years in that first example. Does it last 3? Is it 2? Is it 5? Who knows? And whether historic cost is equal to replacement cost. That amortization, or rather depreciation, for example, we were looking at was 40,000. That was based on the 120,000 cost. If you have an asset that's got a useful life of, let's say, 10 years, your depreciation is based on a cost that's 10 years out of date. The replacement cost could well be a lot higher. So it is just an estimate, but at least it gives us something to base an estimate on. Next up, expansion of existing business. It's getting a little bit more exciting now. Compliance projects were not fun. Maintenance is really just, well, maintenance is not really exciting. It's not going anywhere, is it? It's just keeping the business going. Now we're growing. Either increasing our scale, so the size of operations. Good example given in the curriculum. Research into new medications. Pharmaceutical companies obviously spend a lot on research and development to keep growing, to keep developing new medicines. Or an increase in scope. Extending out to adjacent products. So not just growing the same lines that you currently do, but moving into adjacent products. Computer hardware makers, for example, might move into video game development. It's adjacent. It's not a completely new business line. So it's not a huge risk. You know a little bit about it, but it's still an increase in your scope. Risk is certainly higher than your maintenance projects. Certainly higher than a compliance project. Why? There is more uncertainty. Who knows if we're going to be any good at this? It's going to be a longer project in all likelihood as you try and develop the products, launch the products, market, sell, and so on. And there's going to be more capital involved. All three of those introduce more risk. Specific examples? Well, if it's scale, you're just getting bigger and bigger and bigger. There may be unforeseen problems executing that size project, so sourcing the extra inputs you need. There may be production bottlenecks that you didn't foresee. For increases in scope, well, it's not a completely new project, but you do now have different business lines, and you may experience problems, complexity in trying to manage those multiple lines, and you'll have new competitors. Suddenly you've got to start analyzing the competitors you face in the video game development sector, as well as the hardware you're producing. If you haven't thought all of this through before you launch, you could be in trouble. Funding, well, in the early phase of a firm's life, so startups here, increasing in scale because they're tiny and they're just trying to get going and establish a foothold, equity is typically the only finance available to them. They are perceived as too risky, so they won't be able to access debt. More established firms, more access to debt. They are perceived as lower risk, so they may well finance it via debt. What do we consider as analysts? Well, our key decision here is, or our key piece of analysis, is it likely to be successful? To do that, we'll consider the competitive position of the company. Where are they now? Are people likely to go for their adjacent products, for example, if it is scope? And look at past performance by peers. Have your competitors tried to get into this area as well? How did it work out for them? And we can assess a likelihood of success from there. And finally, brand new lines of business. It says and other, but new projects, new lines, much more risk, the highest risk projects of all. So new lines meaning completely outside or only minimally related to your current business. Examples, capital invested to explore new technology. So that's research and development again, but it's not like the pharmaceutical company who is just trying to develop new products, new medicines along the lines of its existing business, but now a brand new technology or a brand new business idea. Very much like a startup. They are startup-like in their properties and hence very risky. Or it could be via acquisition. It could be an acquisition of a firm in a different industry or sector. They give the example in the curriculum of Kirin, beverage manufacturer, alcoholic and non-alcoholic, making an acquisition of a firm that's in the cosmetics and dietary supplements business. So good food, healthy food. So it's not completely and utterly related, but it's also not completely outside. I mean, cosmetics is, but the dietary supplements, it kind of ties in just about to the sector, but it's certainly higher risk. Risks come from the fact that you don't know what challenges you're going to face. It's an unfamiliar business. Obviously, the more analysis you can do up front, the better. And if it is via acquisition, then the risk of overpayment, especially if you get overexcited and get into a bidding war with somebody else for this company, you could overpay, end up with huge goodwill that you then impair at a later date. As analysts, what do? Well, if you're separating out into new lines of business, there should be in the financial statements segmental disclosures, which will tell you what's going on. Quite a bit of information. You'll see this in FSA, quite a bit of information on profitability and assets in each of those different segments. And you can assess the level of expansion expenditure. We said this earlier on. What you will be able to judge from the financial statements, from the disclosures, is the total capex this company is spending. Maintenance, we said we would estimate as depreciation amortization. So if we know the total and we know what was maintenance, we can assess how much is being spent on expansion projects, which will be useful when we assess management decisions and whether we think they are successful and whether the capital investment and allocation process is rigorous. Let's put it that way. We'll talk a little bit about it later on. But before we move on, let's just make sure we can match up some projects to their types just to make sure this stuff is stuck. I mean, it's not particularly dramatic stuff, but let's just make sure it's in our heads. We have on the left 4 projects and on the right 4 types. Let's see what we think. First of all, office equipment producer. So it's producing office equipment. Develops a new line of peripherals for gamers. So we're into office equipment, peripherals for gamers. So I'm picturing those kind of fancy chairs that light up and spin around and things like that. So we're going from your standard little spinny office chair to a fairly intimidating looking, massive, lighty up, comfy gaming chair that you would see on Twitch. Not compliance. I'm ruling out compliance. Clearly, there's nothing compliancy about this. I wouldn't call it maintenance because they've clearly made a point that it's a different business going from office to gamers. So it's expansion or brand new business. I wouldn't say this was a brand new business. I wouldn't say this is way outside of what they're currently doing. It's still a chair. So I'm going to say this is expansion. Number 2, a tire producer. That's not how I'd spell tire, but I'll have to live with it. A tire producer invests in solar panel. I mean, I did write this to be fair, but that's how it is presented in the curriculum. A tire producer invests in solar panel production to benefit from government subsidies. They are currently producing tires. They're going to move into solar panel production. Now, it's not compliance, and I can see what they're doing here. They're mentioning government subsidies to try and make you think this is compliance. They don't have to do this. They're doing it to try and get free money. So it's not compliance. It's not maintenance because it's not the same business. And I don't even think it's expansion because this is a totally different business. I think this is the new business. It's newbie. Third one, global bank migrates on-site data storage to the cloud to improve efficiency. Nothing here that says they have to do that. Obviously, there are a lot of regulations and compliance concerns around data, but nothing here says they had to. Maintenance. Well, yeah, they're just trying to improve efficiency. I could go for maintenance. They're not expanding or going into a new business. That for me is maintenance. We've got one of each except for compliance. Let's see if the last one is compliance. Property management company installs new ventilation in all buildings to meet pollution regulations. It is obviously compliance. Onwards then to the second LOS, which has a little bit more beef to it. Describe the capital allocation process. So we'll do that first. Then calculate NPV, IRR, and ROIC, and contrast their uses in capital allocation. Let's get to it. The process, first of all, the capital allocation process, the process used by firms' management and board to make capital investment and return decisions. What's the objective? The objective is to earn risk-adjusted returns, which are greater than those the investor could earn on similarly risky investments elsewhere. What investors could earn on similarly risky investments elsewhere is known as the opportunity cost. Another way of phrasing that, it is the best alternative foregone. What they missed out on by giving you their cash instead. But it has to be similarly risky investments. You can't say, oh, well, I could have gone and spent this $1 on the lottery and won 850 million. That's clearly stupid. So it's similarly risky investments, but what would they miss out on as a result of investing in you? The process management goes through, very similar to portfolio construction. If you've been through the portfolio management readings, specifically in the second half of the curriculum where you construct a portfolio, same idea, but it's more granular. What management and the board are doing here is assessing individual projects that the company could take on, instead of looking at entire companies to buy or invest in or put into your portfolio. And they are using proprietary, non-public information. They are inside the company. They know exactly what it's going to cost them to do things. It is non-public info. So it's difficult for analysts to properly review all of these decisions because we don't have access to that information. What are the steps in the process? There are 4 of them. Number 1, think of something to do. Idea generation. Absolutely key to understand your competitive environment when you're coming up with ideas. Know what is possible, what is feasible, what is realistic, and know your competitive position. So go back to the early modules of corporate issuers. Go back to your company and industry analysis. Make sure you know where you're at, what your strengths are, and try and build on those. You may internally generate these ideas. The board may come up with them, or you may hire consultants to come in and say, look, our returns aren't big enough. Our return on investments aren't big enough. We're not investing in the right projects. Tell us where we're going wrong. Tell us where our opportunities are. Once you have the idea, number 2, investment analysis. You have an idea of what you're going to do. Forecast the amount, the timing, the duration, and the volatility of your cash flows. Cash flows, cash flows, cash flows. When you are analyzing a project, coming up with its NPV, it is based on cash flows, not accounting measures. Now, obviously, these are forecasts, so there are questions on how accurate all of these are. We're never going to be absolutely certain that we've got the right figure. 3, plan and prioritize. Which projects give you the most value on a risk-adjusted return basis? Which are most value enhancing? Only choose projects that give you a return greater than the investor's opportunity cost. Remember, that's what we said our objective was. If you can do that, you are adding wealth. Consider the interaction with existing operations. It's all very well introducing a new product, a new location. Is it going to cannibalize others? Think of your finance constraints. It might be a great idea, but do you have access to the finance to get this project going, to finish the project? And if after going through this investment analysis and planning process, you find you have excess capital that you can't use in any projects that generate returns greater than the investor's opportunity cost, give it back. If shareholders have given you cash, it's because they think you can earn more than they could get elsewhere. If you can't, give it them back. And finally, monitoring and post-investment review. Monitor the performance of the project. Obviously, by doing that, you will either validate your assumptions or find that this stage was absolutely terrible and your forecasting was awful and you need to revisit your process. And you can increase or decrease your investment based on how it's going, potentially. If the right to do that, the opportunity to do that, to increase or decrease your investment in the project exists, it's known as a real option. That's the final LOS we'll look at the end of this module. So we have the process. Now the fun stuff, the tools. 3 we had to look at: net present value, NPV, internal rate of return, IRR, and return on invested capital, ROIC. NPV and IRR are nothing more than extensions. Are they even extensions? I don't know. Repeats of calculations you've done in the time value of money reading in quantitative methods. If you haven't yet looked at the time value of money reading in quantitative methods, highly recommend that you do, because you've effectively calculated these already. Return on invested capital, fairly simple accounting measure. We'll take a look at that shortly. Now, the first two, NPV and IRR, they are used by management and the board to assess individual projects. They are dependent on that proprietary information, the non-public information. To calculate NPV and IRR, you need to know in detail accurate forecasts of the amount, timing, and duration of cash flows. As analysts looking outside, or rather from the outside in, we don't have that information. What we are restricted to really is looking at aggregated data in the financial statements. But what we can do from that aggregated data is calculate return on investment capital, or rather invested capital. What return did you earn on that capital overall? At least it's something, it gives us something to go on. But let's go back and start with the NPV. You've seen calculating the PV of cash flows already, so we're not going to dwell on why we're dividing by 1 plus R to the power N, etc. That should be in your head. If it's not, go back and check it. So let's just dive straight into an example. For your consideration here, we have a $50 million investment today. Today is T0, spending $50 million, which will generate $16 million in after-tax cash flows for 4 years. So at T1, T2, T3, T4, we get 16 million and 20 million in year 5. The required rate of return is 10%. We will therefore discount these cash flows to get the present value, as you did in quant, at 10%. So for year 1, dividing by 1.1 to the power 1 year, squared for 2 years, cubed for 3, 4, and 5, and so on. Add all of those PVs up, and what you'll get is 13.136. It is a positive number. What does a positive number mean? Invest, spend the money, do the project. A positive NPV means you are increasing the wealth of shareholders. You are adding value. If it is greater than 0, if it is positive, invest. If it is less than 0, do not. If it's less than 0, you are not creating wealth. Now, I said greater than there. You may be peering hard at the screen and saying, surely, Richie, this says greater than or equal to. And yes, you're right, it does. It says that if you do this forecast, and bear in mind, this project could be a 5, 10, 15, 20 year project. You do this project, forecast cash flows for the next 20 years, and get back down to an NPV of 0, I would be hesitant to say go ahead. Yes, strictly speaking, you are meeting the required return, but Now, with an NPV of 0, you would obviously do a whole world of sensitivity, scenario analysis, and decide what you're going to do. And the curriculum's not stupid. It realizes that. But that's the rule I give you. That is a necessary rule, not sufficient. So if it did have a positive NPV, as I've done here, I just said, yeah, it's positive. Let's invest. Whoa there, hang on a minute. We've no idea what this project is. It could be investing in high-tech weaponry to export to a politically dubious regime. Now, that's probably not something we want to be involved in. So you do have to consider other things, maybe ESG considerations and so on, before you just dive in and say yes. Now, calculating, you don't want to be writing out every single cash flow by hand, obviously. If you've got a calculator in the exam, and you should have, do not go into the exam without the calculator. That said, it's not going to be a huge calculation-based exam, probably 20-30% at most. But you should have your business calculator. Set your first cash flow to CF0. Set your initial cash flow. I don't want to say first. That makes it sound like T1. Your initial cash flow at T0. CF0 to minus 50. Your first cash flow, or rather the cash flow at time 1, CO1, to plus 16. And then you can set the frequency of that cash flow to 4 because it occurs 4 times. C02, the second cash flow, would then be 20. And because you put in the first one 4 times, your calculator knows that this one is going to be at T5. Now, if you press the NPV button, it will ask you for an interest rate. We've got a required return of 10. Put in the 10, compute NPV, and you'll get your 13.136. Or you can use Excel. Excel will not be available in the exam. So you're not going to be using these functions in the exam. This is just for your benefit. If you want to go through, see how this works, practice in Excel, calculating an NPV for this simple example. And it's simple because the cash flows are equally spaced. When it's a simple example, all you need to do in Excel is use the NPV function. The first number you'll put in is the interest rate, your required return. Then you'll put in the values. But note, the first cash flow we put in there was 16 because it's assuming the first cash flow is at T1. That's the one that we just put in here. So you have to put in all of your future cash flows and then just simply deduct the cash flow at T0. Deduct because it is an outflow. Now you don't need to worry about discounting that because obviously it's just at T0. Put that into Excel and it will calculate again 13.136. Now that's all well and good. But what if the cash flows are not equally spaced? Then it gets a little bit more fun. So look at this example. It's similar, but different. We have an outflow of 50. At T1, we have an inflow of 10, but then, this is the wild card, we have an outflow of 5 at T1.5, 1.5 years' time. 13 comes in at T2, 16 at T3, 19 at T4, and 23 at T5. What's our discount rate? Well, it's the same as before. I've not written it down again, but we're going to use 10% once again as our discount rate. So quite simply, for year 1, divide 10 by 1.1. For year 1.5, divide the minus 5 by 1.1 to the power 1.5, and so on. And once again, if you take that long-winded manual route, if you like, you will get down to 4.78, which again is positive, which suggests you should invest. Once again, as we said earlier, you would want to go and check what industry it's in before you pull the trigger. But it's a positive NPV, which means, yes, we can invest. Now, you don't want to do it like that by hand. It's going to take a while. You can use your calculator. All sorts of different ways to do it. Basically, choose your weapon. Whatever works for you in the exam, go for it. What I tended to do is say, okay, if I've got a half period here, I'm going to work in half periods. I'm going to say CF0 is an outflow of 50. That's fairly straightforward. But I'm going to put in cash flows at every half period. So I'm adding in a cash flow all these periods. The first half was 0. Then I got my 10 When I got to a year, my -5 for 1.5, my 13 at T2. There was no cash flow at 2.5, the 16 at 3, no cash flow at 3.5, 19 at 4, no cash flow at 4.5, 23 at 5. I have all my cash flows, but I'm working in half periods. So they're going to be called 1 for that 0.5, 2.5 periods, 3.5 periods for 1.5, and so on. Dump all of those cash flows in. Then I need a discount rate. The discount rate I was given was 10%. I need to turn that into a discount rate applicable for half a period. So I'm going to take 1 plus my rate to the power 1 over 2 and knock off 1. 4.88 is the discount rate I'll use. Put that in, calculate NPV, and again, you'll get to 4.78. Now, is this quicker than doing this? Debatable. Will they ask you to do this in the exam? I doubt it. It's not the kind of exam where they want you to waste time dumping in all of these numbers to a calculator. Do 2 or 3 numbers and you can prove you know the concept. Out there in the real world, if you happen to use Excel for this, the function you'd need to use is XNPV, because the cash flows are not equally spaced. So, quick example of how that works. You need to put in a rate. You need to put in the values. That's where we would have finished if it was just NPV, but it's not. We need to go on and put the dates because they are not equally spaced. So let's see how this example would look. So we have our cash flows across the top, 50 negative, then the 10, the -5, which I've put in halfway through the year, then 13, 16, 19, and 23. Then the dates. The actual start date is fairly irrelevant. The key is the dates I've put in are correctly spaced. So 1 year between the initial outflow and the first cash flow, only 6 months to get to 1.5, 6 months to get to the end of 2025 there, and then annual gaps again. So they are spaced correctly. We're going to use the XNPV function. So in my cell B6, I'll put in equals XNPV. We need to put in the interest rate. We're using 10% again, not very imaginative. That's B4. We need to put in our values. That's the first row from B to H. B1, H1. And I need my dates. Second row, B2, H2. NPV is 4.78. So if you need to do it on Excel, that's how it would work when you have unequally spaced cash flows. And back on the slide, we can see it ties in with the 4.78. What about the IRR? The IRR is the discount rate that makes the NPV of an investment equal to 0. In the simple case where you have only one change of sign in the cash flow, here an outflow initially and then a series of all inflows, all we're doing here is solving for a rate that sets the future value of all of those inflows equal to the current outflow. And if that sounds familiar, it's because you've already done it when you were playing with fixed income back in the world of time value of money. When you calculate the yield to maturity on a bond, you're equating the price paid for a bond today to the PV of the coupons and the principal you get back in the future. The YTM is just like an IRR. So you've seen this already as well. There is no way to calculate it other than trial and error or using your calculator or using Excel. So we've got the exact same example we had here, the first one, the equally spaced one to begin with, where we calculated an NPV of 13.136. What do you need to do to get the IRR? Well, put it into your calculator again, but this time instead of going for NPV, punch the IRR button and you'll get 19.52%. What does that tell you? If your required return was equal to 19.52%, your NPV would be 0. So if instead of using 10s here, all across the board, I use 19.52, this would come to 0. Now let's sit back and look at the NPV. It's 13.136 positive. Why is it positive? Because in this example, my required return is less than the IRR. If I discount at a rate below the IRR, I am not discounting as much, which means the PV of each of these flows will be higher, which means my NPV will be higher because the initial outflow is not impacted. So you would expect, at least for a simple set of cash flows where the sign doesn't change, that if your required return is below the IRR, you're going to have a positive NPV. Can do it on Excel again. Dead easy. You just put in your values. You can put in a guess to give it a bit of guidance. That is optional, so I would suggest not bothering. We're not doing anything dreadfully complicated here. Really easy. IRR, put in minus 50, 16, 16, 16, 16, and 20. Notice it's now accepted that your first cash flow is T0, so you can just put it in there. And it'll give you an IRR. Again, it will come here to 19.52%. But what about unequally spaced cash flows? The concept is absolutely identical. We're not learning anything new here about a measurement or a concept or how to apply it. The only reason they put this in is just to tell you how to calculate it again on Excel. You can't use the basic IRR, just like you couldn't use the basic NPV. And just like you have to use X NPV, here you use X IRR. Once again, you put in the values and the dates, don't need to put in a guess, and it will spit out the IRR. Now let's do it for this example. This is a new example, so don't try and tie it back to the old one where we had a cash flow at T1.5. This one has an initial outflow of 50, nothing at time 1, 1 at time 2, then an inflow of 3 at 2.5, then 16, 20, and 25. Now they gave us a discount rate of 10%. Again, we don't need that because all we're doing is calculating the IRR. So once again, in Excel, we've put in the values rather on the first row, the dates on the second row. Once again, I'd make sure I got my spacing correct. So T0 to T1 to T2, this is only 6 months, so this is 2.5, 6 months to 3, 4, and 5. Now, interest rate is 10%. If you did calculate the NPV, interestingly here, you will get a negative, minus 5.61. But the IRR we're here for, we're going to have to use, as we said, X IRR. It wants us to put in the values, the first row, once again, B1H1. It needs the dates, B2H2. And it'll calculate an IRR of 6.76%, which is kind of interesting. I just highlight it. We have a negative NPV, and look what happens if we compare the IRR to the required return. The required return we used there was 10%. It is greater than the IRR. Hence, we have a negative NPV. And that leads us nicely into the decision rule. Invest if the IRR is greater than, and again it says or equal to, same argument as earlier, greater than or equal to the required return. Do not if the IRR is less than the required return. Hence, the required return is often referred to as a hurdle rate. Just a quick reminder here, we had 10 as the required return. Excel calculated for us an IRR of 6.76%. We're in the situation, as we said, where IRR is less